Since we've passed the halfway mark of the year, I think it's quite appropriate that we just take stock in terms of what has happened in the first 6 months, both in the world economy as well as in the financial markets. If we go back 6 months, we have argued that in terms of the South African situation, that most economists were too optimistic after the positive results that we've seen in the ANC election at the end of last year. As a result of those positive results, we have seen that South African equities have performed exceptionally well up until the end of January. But since then, the market became quite concerned as the market witnessed a tug of war between Cyril Ramaphosa, the president of the country, and Cyril Ramaphosa, the leader of the ANC. And as a result of that, we have seen that South African equities have pulled back and in fact recorded a negative return of more than 6% for the 6 months. On the other hand, global growth continued to perform quite nicely, and global equities and developed market equities in particular still recorded a positive return. However, some of the problems that South Africa faced was also faced by other emerging markets, and emerging markets in general lack their developed markets counterparts. If we look at other asset classes, we warned against listed property in South Africa. Listed property recorded a negative return of more than 13% for the first 6 months. And then, of course, bonds, where we also expressed our concern. Bond yields weakened significantly, only to strengthen a bit towards the end of the 6-month period, but still bonds in South Africa recorded a flat return for the year. Global bonds, as we expected, given the very low levels of global yields, started to underperform. So in summary, I think it's probably true to say that it was a very tough period for investors, and it didn't really matter where you had your money invested. It was a volatile and a negative period to be encountered. The question is now, what about the next 6 months, or in fact the next year or 5 years? What does that hold for us, and how do we position our portfolios given our views? When we look at the prospective performance of global financial markets, there are probably 2 or 3 factors that we should pay attention to. The first one is what will happen with the momentum in the global economic cycle. The second one is what will happen to global interest rates. And then thirdly, and it's perhaps on the periphery, and it will have an impact on the momentum in global economic activity, is to what extent will trade wars play itself out and have an impact on investor sentiment and indeed in real economic activity. Let's start with the economic cycle. We've previously argued that we are in quite an advanced stage of the economic cycle, and we haven't changed our view. The synchronized nature of the economic cycle are clearly starting to show some cracks, where on the one hand, the US economy is growing quite nicely, but in Europe and in some emerging markets, you can clearly see that the momentum is starting to come out of economic activity. As far as interest rates are concerned, again, the US probably ahead of the rest of the world, where we can clearly see that the strong economic activity and the increase in the inflation rate is now enough ammunition for the Federal Reserve to continue with the hike in interest rates, and the strong economic activity in all likelihood will support that action. We are by no means saying that we are going to see an interest rate shock. We are simply saying that the market needs to deal with high interest rates, and they will have to discount that when they formulate a view on risky assets and equities in particular. If I relate those issues with financial markets, we must focus on the valuation of the markets as well. And one of the points that we were quite clear on at the beginning of the year is that global equities in particular for us appear to be on the high side, and therefore we've had to tone down our performance expectations as far as global equities are concerned. Should interest rates continue up, that will certainly also, to my mind, put a dampener on the expected performance from global equities. So when we craft portfolios, of course, what you do is we marry our view in terms of valuation with the actual view on real economic activity. And on the back of that, I think it is, to our mind, it is quite clear that we should lower our expectations in terms of performance expectations for global equities. On the South African scene, things are a bit different. Firstly, what we've seen in this particular cycle is that we did not share to the same extent in the upcycle in terms of economic activity locally. Our economic growth seriously lagged the rest of the world. And therefore, what we've also experienced is that local equities lack the strong performance that we've experienced in developed markets in particular. However, if you look at valuation at the moment, we can clearly, for the first time in about 3 or 4 years, see that the valuations are starting to become more palatable. So although the news flow has turned a bit more negative, the equity market, of course, is a discounting machine, and we've certainly experienced that equity prices have become more attractive. And that simply means that if you have a prospective view in terms of what you can expect in terms of performance, that view has turned more positive compared to the view that we held 6 months ago. To summarize, if we have to craft multi-asset portfolios for our clients today, we remain cautious. We would like to be slightly underweight relative to the benchmark, whatever the strategic benchmark for the particular client is in terms of global equities. If the weakness in South African equities continue, we will start to reduce the underweight position in South African equities and buy attractive assets that are currently not backed up by a strong story. However, we remain negative in terms of global bonds. We remain quite cautious in terms of South African bonds, and the balancing factor, of course, is cash, which not only provides you optionality, but it still provides you a guaranteed return roughly in line with inflation.